Gregory Mannarino. It is Tuesday, February 22nd, 2022. Wow, a whole bunch of twos. Interesting, isn't it? All right, people, look, what's going on? Apparently, there has been some kind of incursion or yet to be defined event that has occurred on the Ukrainian border with Russia. And it's interesting. I'm laughing. I'm laughing again. You can't make this stuff up. I'm sitting here this morning and I'm kind of, going through the mainstream news propaganda ministry outlets. And they're all like, well, what's actually going on over there? Has this been an invasion? Is it an incursion? Or is it something else? Look, whatever it is over there, with regard to you and me, let's just talk about how it's going to affect us sincerely. With regard to the market, last night, before I even knew anything happened, I just happened to, go take a glance over at stock futures, and they were down hard across the board. Dow futures were down over 500, so I said, okay, something's going on. And that's when I started looking around. Well, this morning, stock futures have recovered. I mean, it's incredible. You think that's just some kind of a miracle too? I tell you, man, they won't let the market fall. Anyway, so yeah, stock futures are slightly lower after being down hard across the board right now. This is a game. You know how it's being played. You know the Fed is buying the market. Period, the end. So with that said, look, I have explained to all of you that if in fact bullets start flying over there, it doesn't look like that just yet. What do I know? I'm not over there. But once it becomes common knowledge, let's put it that way, that bullets are flying over there, I would expect to see the market take a hit. And like I said also, it'll be short-lived because you can expect again the same thing to occur. That is, the Fed's going to get in here. They're going to buy the market. There's going to be a massive rebound here. And I will be in here. There's no doubt about it. I will be buying this dip, especially with the banks. You know what I'm talking about. If you follow my newsletter, I've been putting this out for months and months and months. J.P. Morgan, Goldman Sachs, Bank of America. Nothing is going to get in the way of these institutions moving forward, and I really mean that. Anyway, with that said, let us again move forward here. Energy is insane. We have an over 3% gain in WTI crude right now. No shock. Natural gas. I mean, the energy sector is going to definitely catch a bump here moving forward. I have no doubt about it. And like I said yesterday, people, be ready for another crisis. We go from crisis to crisis to crisis. They're already setting it all up. A global energy crisis. And you can only imagine what that's going to mean for the price of goods. It's going to be insane. Again, inflation, you haven't seen anything yet. Now, talking about inflation, believe it or not, despite whatever's going on over there right now, the relative strength of the dollar or the Dixie is lower. Lower. Interesting, isn't it? And you got the 10-year yield about 1.95. Okay, still below 2%. We're going to settle above 2. I'm certain of it. At one point, we were above 2 recently. And then, you got the safety trade, the fear trade. I am just so curious to see how this is going to play out. I really, really am. Let's look over at a couple of other assets here. Gold and silver catching a bid. Cryptocurrencies fell under pressure. Bitcoin around 38,000. Okay. I explained this recently in an article I wrote on my free newsletter with regard to cryptocurrencies and how they react to market shocks. It's too new of an asset to have a long-term record of this. All we can expect is increased volatility, and this is not even close to a market shock. I mean, even yesterday or overnight when we had, I'm laughing, when we had stock futures down, Dow futures down over 500 points, okay, Okay, whatever. I know what you're doing. You're looking over at the debt market just as I am. And there's nothing going on here. You got a stable 10-year yield, although lower, meaning cash is going into the debt market. And you and me, we have no fear of that. Zero. Okay, you and I, we're worried about and are anticipating the inevitable, and it's going to happen. I mean, it's going to happen in a big way. Spike of the 10-year yield, meaning that debt is selling off, and that's going to melt the stock market and just cause cash to move from one set of lovely assets to another set of lovely assets. You understand? Very simple, but we're going to stay on top of this, people. Look, I have explained to you, we really can't be beaten. Okay, our portfolios are going to bounce around here and there, but if you're hedged, and you know what I mean by that, you're in risk-on assets and risk-off assets at the same time, you can sleep nicely, not worrying about what may happen to your overall portfolio. You understand? You got to do these things, and I definitely don't want any of you to be in any single asset class. You must be somewhat diversified to withstand these kinds of things. And I know it can be stressful because, believe me, my email box continues to light up like a Christmas tree with people that are concerned, very concerned about where the market's going to go, what it's going to do. You know, look, markets just do what they got to do here with regard to equities. Random walk here with an upward drift. And it's the debt market, which is the driver. I don't know how many times I have to say this. And if you are understanding that, if you're looking over at what the 10-year yield is doing, what the relative strength of the dollar is doing, what the MMRI is doing, I haven't even looked at it yet. The MMRI, Mannarino Market Risk Indicator, I would imagine looking at futures right now, it's probably lower. I mean, it's probably going to be lower today. Keep your eye on that. Again, link in the description of this video. My real concern right now is energy. All right, we understand how what's going on here, how this is being set up here, and I think we're going to see much higher energy prices moving forward, and that's going to hurt people. And that's going to hurt them badly. And again, it's going to be used as a scapegoat. Oh, look at the surging energy. That's the reason for inflation. Anything to deflect off of these criminal central banks that continue to buy assets with, none more so than the Federal Reserve. It's insane how they're allowed to do what they're doing right now. They have one product, that's debt. They continue to issue more and more of it every second of every day, 24 hours a day, 365 days a year. It doesn't stop, ever. Do you find that disturbing, interesting? What's the term here? It just will not stop. And that is, again, part of the mechanism here of central banks, what they want to do. We're in the middle of a global takeover without firing a single shot. Forget about Russia, Ukraine, anything else, military incursions, whatever might be going on. No, central banks they run the entire economy, the entire world economy and financial system, and they're dragging it along in any direction they want to simply by manipulating their one product, which is debt. It's outstanding and frankly retarded to me that we've allowed this to happen. We've done this, people. Anyway, so yes, energy. Keep your eye on this. I really feel like we're moving towards a full-blown energy crisis, a new Cold War, and an arms race here, which is going to give central banks the green light to continue to inflate on a scale that we can't possibly believe. And again, if we understand that mechanism, let's put another perspective on this. If central banks are going to finance this new thing that's going on here with regard to an arms race and arms deals, which they are financing all of this, what does it mean for the market? Well, that's pretty much how it's going to go here, people. And you can expect fiat currencies globally to continue to lose their absolute value, and inflation is going to continue to surge People have no idea what's coming down the pike. I know you do if you follow this blog. All right, people, look, I pretty much summed this all up. Let's see how this works today. Couldn't be more interested, really, honestly. And in the event of a dip here in the banks, this morning, I will be buying. I will be buying as much as I possibly can here, people. As you know, my take has not changed. The debt market, there are no red flags, which means to me, this market is going higher. Okay, there's no crash here. There's no anything going on, as a matter of fact. And all the talk about tapering, which never happened, with regard to meaningful rate hikes, this is going to, if anything does happen over there, this is going to give the Fed pause by design. Again, the Fed doesn't want to raise rates in any meaningful way, and they're not going to. All they want to do is inflate. That's how central banks retain their power, by inflating. So again, let's keep our eyes on this. I know you are. I got you. I got your back, and I'll keep you ahead of the curve as I always do. This guy loves you a lot. I'll see you at the end of the day.